Welcome to Jazz After Dark, everybody. How you been? Hope all is good there. We are financial advisors here at Jazz Wealth. This is a sort of a special evening edition episode that we do where we just lay back and try something different, something we've maybe never had to drink. And we're going to do that here tonight while we learn about total returns and price returns, the sneakiness and the geekiness behind them. And we talk about the stock market and investing and trading and stuff a lot more than any other advisor, because that's our background. We are fund managers by trade, and so we bring that to our clients here at Jazz Wealth. I'm going to do some open houses, maybe in the coming week or two, where it's live, we take questions and stuff, but I'll teach you something and then just real quickly share something about us. But for example, in our funds here, this is our aggressive stock fund, we have the ability to talk to clients about how we had a cash as a position during the weakest parts of all last year. And so our performance at this point is better than the market in our aggressive funds because, well, we weren't 100% participating, and now we have the ability to use cash to buy things at a discount. No other advisor is going to be on YouTube talking about that. Number one, because they think they'll get in trouble. But number two, I don't think they have that skill set. Tonight we are trying from Flaviar. This is that group that we have a discount code if you want to participate, but they send these cool little boxes that have different types of flavors in them. And we are doing a whiskey tasting of Balcones. And I looked them up, pretty cool. It's like just kind of like Jazz. They're like a little startup company. It was like 2008, the worst time to get started. They said, you know what, we're going to do this. Some crappy old building, and they got started there. And so tonight we're trying their Lineage Texas single malt whiskey, 47%. Says we should have some tastes of apple, pear, and pie with caramel, bitters, toffee, and oh God, yeah. Oh, I get the apple on the smell there. Very much get the apple on the smell. Oh, and it tastes, oh, that is phenomenal. That is phenomenal. They, this week, by the way, we'll be doing a series of these are all by them. And so we'll be doing a couple different tastings. That's phenomenal. I love fruits in my whiskey there. I think that's a great flavor. Pear and apple are right there. Pie, I don't know about the pie so much, but that is really good. I'm going to say that ranks up there with what we had last week, that Spirit of the Oak. That ranks up there. That's an 83. That beats that. That's an 83 because it's not as sweet. All right. Ooh, that is good. And it continues to deliver that fruitiness there. All right. Total returns versus price returns. You know the difference? Well, price returns are the returns that you get from the stock simply just going up. Presumably, we're talking stocks in this case. And total returns are your price appreciation, stock goes up, plus any dividends that you got along the way. The really simple explanation is you buy a stock that goes from 100, where you bought it, to 110. What's your return on that position? Is 10%. So that is your total return. However, it's also the price return in that case because I only gave you one number. What if I said the stock went from 100 to 110, but at the same time, they paid a $1 dividend. Over the course of you owning that stock, you gathered a $1 dividend. That would mean that your price return was from 100 to 110. In other words, you made 10% on your risk or what you took your shot on. But you made a $1 or 1% dividend along the way. And so you really have an 11% total return. The price return is 10, total return is 11 because we're including the dividend. So that's the really simple explanation. What I've done is I went through all the index ETFs and all the sector ETFs of the S&P, and I'm going to share that with you to show you the difference between price return and total return. And we're going to go back all the ways to the beginning of these each individual sector and ETF. And the reason we're doing this is because you should know where you're getting your total return from. You might know that if you buy the utility sector in the S&P, I'm gonna have to enjoy some more of that. If you buy the utility sector, you know that's not going to move as fast or appreciate as fast as say, the tech sector or communication services sector. And that's just by makeup of the products that are underneath it, the individual stocks. Utility stocks tend to move a little bit slower. They're not as exciting. They pay a larger dividend. And so it could be that at any given moment, your total return is actually larger than investing in the tech sector. Not going to be a lot, but it may happen from time to time. And that's because of the dividend. So we're going to go through each of those and talk about the percentages that you get from each individual one. Don't let this scare you. There's going to be a lot of numbers showing up. Might go 84 on that one. Let's dive in here. I hope you're enjoying something as tasty as I am here tonight. Yep, I'm ready. All right. So on the top, we have the S&P, NASDAQ, Russell, and the Dow. These are the ETFs that I use just for full transparency. And then I put the date that we go back to, which is the very, very first date. The S&P, SPY is the first and oldest ETF ever. This is the one. They call it the granddaddy of all ETFs because before there were any ETFs, it was the SPY. It was the first, January 29th, 1993. So any data that you see to the right is going to be from that date forward. What we're looking at here in columns is, of course, the inception date. And then we're saying the price return since then and the total return factoring in the dividend. Then we're talking here in terms of yearly, right? Your annualized return, or what would you have made on an annualized basis? In other words, not every year, but essentially an average. And then what would your total return be? And then I went one step further and said, what percentage of your returns came from dividends? So for example, the SPY has a total price return of 871%. Total return is 1579. Look at the difference there. Holy cow. If you invested in the SPY and took your dividends as they paid and just, I don't know, bought candy bars or whatever it is you bought with it, right? You would have a substantial difference in your returns. So someone over here could say, I invested in the S&P and I made 1,500% since 1993. Someone over here could say, how is that possible? I only made 800%. The single differentiating factor could be, did you reinvest your dividends or let that cash build up and do something else? Even if it was only for a year that you let the cash build up and you didn't reinvest it, then you caught it and said, oh my gosh, no, I want to reinvest my dividends, your returns would be pretty much widely different than the person that said reinvest the whole way. Since 1993, the average return in the S&P, look here, 8%. So those of you, when I do these other videos and I'm like, we're going to use 8% for your total or for your returns, and I say don't invest in dividends, and you leave the comments, you go, that's not right, you don't get that kind of return, I don't know what he's smoking. That's the data. That's not my opinion, that's the data. If you reinvested your dividends, the total return is 10%. Okay, so we're going to stop off here for just a second, hard stop, and we're going to work on something. When somebody tells you that the average return of the S&P is 7%, they're not lying to you. That's actually very accurate. However, the actual total return of the S&P is 10%. You can cherry pick sometimes and make it less or more. That's not fair, but the actual average return is 10%. The reason we say 7% is because we adjust for inflation. Most everybody will take 2.8% out of the total returns and account that towards inflation. And that's right. I have no argument with that. We usually round up and just say 7%. So if you have 10% average returns and you take 3% out for inflation, that's how we come to 7%. So if you ever see that, you'll know why. If somebody says 10% returns, which I often do, I will say 10%, but if you watch very closely, later on, we back out inflation. And that's a lot of times because I'm doing something individually for somebody. I'm saying your total returns will be 10%. However, and then I'll go through and say, because you have this goal and these things that are happening, some of these dollars get spent, some get reinvested. Now we back out whatever inflation average you want to use. All right, so a little side lesson there. All right, so that's the S&P. So we got 10% returns with the dividend included, and 44.8% of all your returns since the inception came from the S&P. So very important that you enjoy those dividends in the form of enjoying them back into the S&P if that's how you're going to invest. The NASDAQ, as you might imagine, is a little bit less because this is comprised of tech stocks that don't often pay dividends or large dividends. 543% price returns, 644 total returns. You see the tighter spread there, and that leads to 8.3 and 8.9%. Only 15% of your total return came from dividends, 644.2. So not as attractive there. The Russell 2000 falls into a similar group because those are smaller cap stocks. They are sort of up-and-comers. They hope to be large one day, or maybe they're happy where they're at. They don't often pay large dividends, and only 30% come from that, which is nothing to sneeze at, but I mean, compared to 44, you get it. The highest paying is the Dow. Now, if you'd have told me this ahead of time, I'm not sure I would have guessed this, so I'll be honest. So total price returns only 331% since inception, 630 as the total return. This is because the Dow often switches. They switch the same amount, like there's 30 stocks, sometimes 31 in the Dow. They will pull stocks out and put other stocks in, not as often as the S&P, but because there's only 30 or 31 stocks, if they make a change, what would that be? 3, 6, 9, 12, 15, 18, 21, 28, 30. Like if they make a change once for every 20 times the S&P makes a change, then it has a greater impact, right? Because there's only 30 stocks versus 505. Hope I said that right. And so it looks like their total return is higher, and on paper, it actually is. However, even though the greater percentage of your returns come from dividends, your highest total return is in the S&P. So I hope you get that distinction there. If you're investing for less volatility and you want your returns to come more from dividends, you might consider the Dow if you're older in age or have a shorter term sort of time horizon. So don't let me try to convince you that the Dow is better. It's not better, but it does generate more returns from dividends than any other index out there. All right, so a lot of you know that in the S&P, there are 11 sectors. And this is a little bit tough because some of the sectors have adjusted here. For example, the communication services, that used to be called telecom, and unfortunately, I didn't want to take the time and go back to adjust for all of that. There was no communication services prior to 2018. It was called telecom, and they shifted some things up, put some of the stocks in tech, and then they left some here and changed it, and so I can't go back and get that data. Nonetheless, it's the same data here. Just notice the dates so you don't confuse yourself into thinking that one is better than the other. And you can see the difference in price returns versus total returns. And this goes back to the utility comment that I made a minute ago. If you invested in the utility sector, you do better than financials, I guess. You know, you match the energy sector. You can see it ranks at the bottom in terms of best total returns. However, of those total 7.8% annualized returns, more than half of them come from the dividend. So you might invest in utilities and say, well, this sucks. I'm getting 4.1%, whereas I look around and I could do better almost anywhere else. However, your total return, at least as of now, beats other sectors because that dividend is sort of picking up the slack, right? So it's making up for the fact that this is a slow-moving sector. And I point that out really because there's nothing wrong with utilities as an investment or an addition to your portfolio, but if you're staring at it, you know, every week or every day and you're like, Dustin, this sucks, man, it's not moving, let the dividends build up a little bit. Look at your total return. In fact, if you were to use like a sector-based investment model, I would say in consumer staples, of course, energy, financials, and utilities, really let the dividends prove your returns and focus on this column here. If you're taking the risk of tech and consumer discretionary, then we want the price returns to be the main focus. There's a problem if if consumer discretionary starts paying a dividend, it's a problem, and very likely that those stocks are going to get shifted somewhere else anyways, but that might move it to a consumer staple. For example, Target. So Target is now a consumer staple stock. As of this very video, it's no longer consumer discretionary, right? So it's more of a staple. It of course has done well with its dividend. We'll raise it. It's typically a slower mover and will now be considered a consumer staple stock. So that happens, and that's just extra knowledge for you, that things that we keep up on. Um, yeah, that's pretty much it. I just wanted to cover that briefly and sort of take your eyes and put them somewhere else for a moment and maybe have you look at things a little bit differently. I enjoy doing that on this show. I get a lot of positive feedback, and even the negative feedback is usually just a disagreement, but it's still people agreeing with the facts and the data. It may just have a different way of going about it, and that I have no problem with. There's a million ways to invest in the stock market, a million different ways to put portfolios together. And the only wrong answer is if you lose money, right? So if you're choosing to go this way, that's fine. If I'm going to go this way, we can disagree, and it really doesn't bother me. Remember that it's very difficult for me to do a video for all of you when every one of you have different lifestyles. I literally have now a client, brand new client, who their family sold off a trailer park, a nice trailer park down here in the South, over the course of a couple of years. They paid him the money out of a trust. We have to go wildly this way with his planning, his investments. He's very young. Maybe it's a fascinating story to tell you guys how he found us, actually. But we have to go this way. So this video might be interesting to him just as a source of knowledge, but we're not going to use a lot of this for what we're doing. And so I understand that, and I accept, the criticism if, it's not perfect. Everybody's different. And that's really why I don't give Dave Ramsey a hard time, because kudos to him. Like, if you can motivate people to invest, save, pay off debt, and do all the things we hopefully don't get in trouble with, but still like speak to a large audience, even though the more you talk, the more segmented it gets, that's killer to me. I think he's doing a great job. Anyways, I will, I'm going to wrap it up there. We'll see you tomorrow on The Closing Beat. It's a live show we do every day. It is based on the stock market, the performance, our adjustments in our portfolios, ideas, lessons, and things like that I can promise you no other advisor is posting videos like that. And I'm not picking on them. It's just, we're a different animal, so to speak. I'm going to finish this drink and enjoy this in chilly Florida here. I know, I'm complaining. I shouldn't be complaining, but it's cold. It's like 68 degrees. All right. Thanks for watching. See ya.